G'day, I'm Steve Hogden, Managing Director of Azimuth Financial Advisors and Authorised Representative of Aon Hewitt Financial Advice. Today we're discussing the impact of the federal budget that was handed down by Treasurer Wayne Swan on the 14th of May. The bottom line of this year's budget reveals a blowout in the budget deficit to $19.4 billion this financial year, followed up by another of $18 billion next year. Now this is vastly different to the $1 billion surplus that the Labor government had promised in last year's budget. Instead, the new target is to return Australia to budget surplus by 2016-2017. Now at a glance, the 2013-14 of this year's federal budget reveals a rising budget deficit brought about by a sharp drop in tax revenue, combined with big ticket spending commitments for disability, education and infrastructure. Additionally, previously announced superannuation and retirement changes and an increase in the Medicare levy and restructuring of those benefits have been announced. With the federal election set for September 2013, this budget has been described as, quote, the weirdest pre-election budget in Australian history. It doesn't contain voter sweeteners, nor does it cut to the bone or adopt European-style austerity measures. It's even been described as a political trap set to catch Tony Abbott to force him to adopt Labor policies. Now, the major reason behind the rapid increase in budget deficits has been attributed to a shortfall in government revenues. The mining tax has failed to deliver what was promised, and instead of $13 billion over 4 years, Treasury are now telling us that the mining tax is going to hit closer to $3.3 billion. That's a fairly significant shortfall. With a stubbornly high Australian dollar, our manufacturing and retail sectors have performed far worse than expected, and company tax receipts are well down on those that were forecast. The economy is slowing, and with that moderation, Treasury has reduced its forecast for GDP growth in 2013-14 from 3% to 2.75%. Now this will in turn translate to even lower tax receipts for the next year. Now relative to other developed nations, we're still going pretty well, and net government debt remains low, and that's projected to peak at 11.4% of GDP. Now despite what Tony Abbott says, this is pretty competitive when we compare it to Germany, with the current net debt to GDP of over 50%, and the USA and UK each above 80% in GDP. Now in spite of the size of the deficit, both Moody's and Standard & Poor's have retained Australia's AAA rating as a result of this budget. Now unemployment rates are expected to rise slightly over the next 12 months to 5.75%, then they're going to stabilise. Now this is still one of the lowest unemployment rates in the developed world. The proposed changes to marginal tax rates and income thresholds, which were due to take effect on 1 July 2015, are no longer going to go ahead. Now since these cuts had not even eventuated yet, there's no real impact to your cash flow at this stage. Our planning is going to change a little bit, that's all. This budget contains a number of changes to the Medicare levy, including an increase from 1.5% to 2% to fund disability care, which is the new name for the government's National Disability Insurance Scheme. Now this has been widely discussed in the media and has received bipartisan support. Legislation to enact a change in Medicare levy will be tabled before the election. Now the impact of this increase is going to range from somewhere in the vicinity of $250 per annum for someone earning $50,000 a year to about $1,000 per annum for someone on a salary of $200,000 a year. The Medicare levy thresholds for low-income earners are going to be increased, but then they'll be frozen for the 2013-14 and 2014-15 financial years. This means that in real terms, the Medicare levy is going to catch more low-income earners over time, thereby raising more revenue for the government. In addition to these changes to the Medicare levy and the thresholds, from 1 January 2015, the extended Medicare safety net is going to be increased from about $1,221 to $2,000 per annum. Now the safety net is an adjustment to the rebate paid once a minimum spend on healthcare has been met each calendar year. So if you have a year where you're going to the doctor a lot and you spend more than $1,200, then you're going to get a bigger rebate back from the government. Now there hasn't been much discussion about this in the media yet, but I think there's going to be, as people grasp that it's going to be more expensive for healthcare going on. Additionally, the net medical expenses tax offset is going to be phased out over the next 7 years. Now, there's a complicated transitional arrangement that's going to take place over that time, but the offset currently allows taxpayers to claim back medical expenses on their tax return. That's going to be phased out, and we're not going to be able to do that anymore. Again, this hasn't seen much press yet, but I think it's going to have a massive effect on medical care and the cost of it, and particularly for people like young couples who are trying to have babies through IVF, where their treatment can be extremely expensive. We're going to see a real impact in that space. From 1 July 2014, work-related self-education expenses are going to be capped at $2,000 per financial year per person. Now, currently there's no cap on the amount of work-related self-education expenses that can be claimed as a tax deduction. Education expenses will include formal qualifications and associated tuition, fees, textbooks, stationery, travel expenses, conferences and seminars, and self-organised study tours, etc. Now, currently there's no fringe benefits tax on education and training provided by employers for employees. Now, this treatment will be retained unless an employee's salary sacrifices to obtain the benefit. So already we've got a tax arbitrage situation going on here. Now, this means that the education paid for by an employer will be FBT free, but if it's paid for by the employee by salary sacrificing, it won't be. The budget also removes the bonus for upfront or lump sum repayments of higher education loan program debt from the 1 January 2014. Now, university and other eligible students are no longer going to be able to receive a discount if they pay their fees up front or repay their help debt early. Now, look, I'm really confused about this one. Encouraging people to pay up front must be better for the nation's accounts than having a loan spread out over decades, and it's been proven that kids are going to university and it's taking 15 or 20 years to pay off their HECS debt. So I see this change as reducing the incentive to pay university fees up front, which is effectively a loan to the Commonwealth. And I'm not quite sure where they got their maths from here, but I'm not seeing it at the moment. Now, the proposed reforms to the Australian super system that were announced on the 5th of April 2013 have been confirmed in this budget. We're producing another video which will discuss these changes in greater detail, but to summarise, the reforms include increases to the concessional contribution cap, excess contributions tax reforms, a reduction in the tax concessions for high income earners, changes to the tax treatment of superannuation pension asset income, changes to the way in which income from superannuation pensions are deemed for settling purposes, additional super tax where income exceeds $300,000 per annum, and now that's going to apply for this financial year, and deferred lifetime annuities are to receive the same concessional tax treatment afforded to super assets supporting income streams. Additionally, there will be changes to the administration of lost or inactive super accounts. And finally, the government will be bringing in a council of superannuation custodians to oversee superannuation policy going forward. Now, one of the other budget reforms that's been announced is that from 1 July 2014, the government will be trialling a program to help all Australians move to more age-appropriate housing. Now, the program will apply an assets test exemption to age pension recipients to downsize the family home. Now, to be eligible, the family home needs to be owned for at least 25 years, and at least 80% of the excess sale proceeds, up to $200,000, need to be deposited with an authorised institution. So basically what this means is grandma and granddad can sell their big house, downsize it, put some money in the bank, and it won't have their pension affected. We think this is a great opportunity. Now, so-called middle-class welfare has been reined in a little in this budget. The baby bonus is going to be scrapped from March 2014, and that's going to be replaced with a $2,000 increase to the family tax benefit Part A for the first child and $1,000 for second and subsequent children. The government has also scrapped the planned boost to family tax benefit Part A that was going to apply for everyone else, and that's going to save about $1.8 billion over 3 years. Now, that increase in family tax benefit Part A was worth up to $600 a year for eligible families, and that was supposed to start in July 1 this year. Additionally, families will now have the maximum amount of childcare rebate that they can claim capped at $7,500 until the 30th of June 2017. So if we add the Medicare levy and the medical expenses offset to these, and the cost of having kids and raising kids after March next year has jumped considerably as a result of this budget. We're going to see increased cost in childcare and increased cost in medical costs associated with looking after them. Now, disability, education and infrastructure, these were the three big tickets items in the budget. Now, the $14.9 billion disability care scheme will be partly funded by a 0.5% boost to the existing Medicare levy from 1 July 2014. Now, we've already discussed that. Now, that's going to provide $3.3 billion towards the cost of running the disability care. So that means it's not fully funded yet. Additionally, the government will cut higher education spending to universities in order to direct $2.3 billion from universities towards the Gonski education reforms. Additionally, significant levels of infrastructure expenditure will occur as a result of this budget, including funding for railways in Western Australia, roads and tunnels in Sydney and Brisbane, and so there's been a massive spend on infrastructure. It's important to understand that most of the announcements in Wayne Swan's sixth and widely tipped to be his last budget will not be legislated until after the election. Ross Gittins of the Sydney Morning Herald said in his column in the day after the budget that, quote, "Since the chances of Labor's re-election seem low, this is more Tony Abbott's budget than Gillard's. It will be he who decides which measures survive and which don't. Whether Labor's last budget becomes anything more than its final impotent gesture remains to be seen." Okay, thanks for watching. As always, the information contained in this video is general advice only. If you need more information on what general advice is, please click the link below. Don't forget to subscribe to us up here, and you can check out our other videos along the bottom as well. Don't forget we're on Twitter, Facebook and even the telephone, so if you've got any questions, feel free to hit us up. We're here to answer your questions and we'd love to help you. Thanks again for watching. We'll see you soon.